Hello, welcome. Happy Friday. Good afternoon. Thanks for joining us today for an expert panel on multifamily hosted by Colliers International. Our sole focus today is the performance of multifamily during a tough time of COVID-19. While we recognize that none of us have a crystal ball, this discussion with some leading minds in the multifamily world will provide several unique perspectives on the short, medium, and longer term impacts of commercial real estate, especially with the multifamily space. So these panelists need no introduction, which is probably why you're here today, but I'm gonna do a quick rundown just so we have a bit of background. Dayma Itamunoala of Colliers International, he's a senior sales representative, is a member of the national apartment team at Colliers International, where he focuses on large apartment and townhouse dispositions across the GTA. Along with his team of 6, Dayma works with both private and institutional clients to comprehensively and creatively navigate transactions, optimize portfolios, and provide strategic advisory. Dayma's successful track record is a result of an acute understanding of the multifamily market and strong relationships within the industry. A special thank you to Dayma for helping me organize this today. In this space with his CRE Library podcast, which if you haven't checked out, I'd encourage you to do so. His session with John Love last week was absolutely amazing. Next, Duncan Smith, Director of Investments at the Daniels Corporation. Duncan is the Head of Investments at the Daniels Corp, an integrated developer of residential and commercial properties. Duncan has spent almost a decade at Daniels, and in that time has been involved in several very high-profile transactions in the GTA, including the Regent Park revitalization. Adrian Rocca, CEO of Fitzrovia Real Estate Inc. Adrian is the CEO, a developer, CEO of Fitzrovia Real Estate in high-value locations. Having also previously worked at Tricon Capital, Adrian has extensive experience and has a deep understanding of the inner workings of the multifamily market and execution from beginning to end. Adrian's got some exciting projects on the go right now. Greg Romundt, President, Centurion Asset Management. Greg is the founder and president of Centurion Asset Management. He's been involved in real estate transactions since the early 1990s, has a global understanding of markets, having worked in Europe, Asia, as well as North America. Jeremy Wedgbury, Senior Vice President, Commercial Mortgages with First National. Jeremy is the Head of Commercial Mortgages Department with First National, which is responsible for underwriting a broad range of commercial products across Canada. As such, Jeremy is uniquely positioned to provide insights on the commercial real estate market from a lender's perspective. We had a lot of questions prior to the panel launching today on this segment, so it should be interesting to get Jeremy's insight. And then finally, Mike Tsourounis, Managing Director, Real Estate Investment Management of Timbercreek. Mike is the Managing Director of Real Estate Investment Management at Timbercreek, a global asset manager. In his role of overseeing Timbercreek's direct real estate platform in North America, Michael has been involved in over $6 billion worth of real estate transactions. So I see a lot of questions in the chat kind of pouring in. We're going to try to attempt those at the end. If we have time, I suspect we will not. But we tried to answer a lot of questions which have been forwarded prior to today in the content. So let's dive right in. The topic of rental collection has been the most popular question I have received from an appraisal standpoint. So let's just talk a little bit about what we saw in April and the outlook. I personally surveyed 8 to 10 of my clients just to understand the realities of the situation and how I'm going to handle this in my appraisals. And the response was overwhelming that 90%, by mid-month, mid to late in the month have been collected. With very few requests for deferral. So April's looking very strong. Review of REIT data suggests the same. Collections are off just a few percent from historical levels with, 1 to 2% asking for payment plans or deferrals. I'd like to turn it over to Mike and Greg, given your existing portfolios. What are you seeing within your portfolios, and what is your outlook for May? Mike, why don't you kick us off here?
Yeah, thanks, Matt. So through April, we collected kind of mid-90s% of our total rent, which we felt pretty good about. We were obviously, like most people, heavily anticipating what April 1st was going to be and what it was going to look like. It was probably a little bit slower start to collections in the month than what a normal month would have been. But as kind of the days and weeks went by, we ended up getting our collections up to be pretty high. Our portfolio goes, across the country from Halifax out to Alberta. The only province we don't have anything in is BC. And it was a pretty consistent collection ratio across all the provinces. We did, interestingly enough, and I don't know if it's a theme, maybe a bit too early to tell if it is, but the provinces where we didn't have rent control, we seemed to collect more rent there earlier on. So in Nova Scotia and Alberta, but generally we got we got pretty high collections. So we have had tenants obviously apply for some rental deferrals. Like most of our peers, we're obviously happy to work with those who are who are experiencing some financial hardship right now. Everyone's in this, everyone really is in the same situation at the same time together, and by no fault of anybody. So we're happy to work with our tenants and to work with all of our customers, and and make sure people have a little less stress surrounding that. And we've been really pleasantly surprised, and I think it there's a lot of really good feel-good stories and that have come out of this, where those who can pay have paid, which has been awesome. And we've had a lot of great stories amongst a lot of our residents who have been there to help out, helping out some neighbors with running errands and all that stuff. So we've had a lot of really great stories kind of from within the portfolio, which has been nice. And I'm sure lots of our peers and colleagues in the industry are experiencing the same thing. So that's been our experience kind of through the first few weeks. Obviously, May, everyone's going to hold their breath a little bit for May as well, just because there is some unknown. Hopefully, with some more of the government stimulus packages that have come into play, and people are starting to get those payments. We hope that those continue to at least pay some of the rent, and those who can afford to pay keep paying, because that's what really keeps the system going.
So our experience is pretty similar. We had, I think month to date, we're about 1% below benchmark, which really is astounding and outstanding at the same time. We, I think there was a lot of chatter in the industry before. People were worried, they'd heard about these, the rent strikes in various locations and that kind of social media movement that popped up. And so people are a little bit more concerned than they probably should have been. So we're somewhere in the mid 90s, like 95, 96%, which is about a point below where we'd normally be at this time. Interesting is, according to not only our data, but with other people we've talked to, about 0.5%, I think in our case was 0.45 or somewhere around there, percent of tenants actually asked for some sort of payment plan in advance, which seems to be remarkably consistent. It was really quite amazing that it was so low. Anecdotally, I've talked to a number of bankers who've said that the request rate for deferrals was somewhere in the neighborhood of 12, meaning that 20 to 25 times on a relative basis the number of homeowners who asked for a concession of some sort relative to rents. So, I think that's it really speaks to the strength of the apartment market, and that people, particularly in markets where rents that are in place are much less than at market rents. Even where in provinces like Ontario, where they said there's not going to be any evictions, people, I think, were wisely did the smart thing, and not try and play tricks with not paying rent when they could. The CREB certainly made a big difference, in my opinion, in terms of people's abilities to pay rent, and we're pretty optimistic as to May's rent.
Oh, that's awesome content right there, Greg. How are you seeing your student product? What are you seeing in that space?
So student product, it's interesting because normally at this time of year we have, call it 25% physical occupancy. And some of our properties, it's now 50 to 75, which is curious. I thought, well, why would that be the case? Well, it seems that, you know, a number of foreign students have decided or are unable to go back home. So even students we thought were leaving for the summer have decided to stay. So occupancy is actually higher than we anticipated. Payment rates are very similar. There were some that vacated early and went back to China. And, you know, this summer months tends to be in the student housing business one where we are generally speaking collecting more regularly than apartments. We do have very good track record of collecting from them eventually, but it seems students, when they go off for the summers, they seem to forget about their landlords, guess that there's better things to do, but they eventually catch up, and we don't have a bad debt rates that are worse than the apartment sector. So, you know, I think that the concerns about impending doom in the student housing market really just didn't materialize either.
Dayma, I want to kick it over to you. What are you seeing in the brokerage side of things? I know you were active in a number of discussions. It'd be good to get insight in that space, especially as it pertains to student.
Yeah, thanks. Yeah, so this is a good question for us. We actually are currently under contract on a 342 bed student apartment in the heart of Toronto. So we are very actively watching how people are perceiving the asset, how people are perceiving student housing in general. And hopefully I can add a little bit to what, Greg, what you were saying. You know, I think a lot of the landlords right now are kind of focused on the two big issues. One is that rent collection. So, you know, April 1st, as Greg's mentioning, that's the same as what I heard across the board. Rent collections were kind of similar or even better in a number of cases. And why would that be? Well, you know, in student housing typically demands a better covenant. You have guarantors, you have, you know, credit worthy tenants because it's their parents, household incomes that are $200,000 or more as compared to traditional multifamily, which is much lower, credit ratings that are typically much higher than traditional multifamily. So rent collections, I think we're good because of that. And I think they'll continue to be good, hopefully throughout the summer months. And then the second big issue is leasing. And right now, a lot of student housing operators operate on a 12-month leasing schedule. They lease from May to May, and then some of them lease from September to September. So for those who lease from May to May, they're already finished their leasing activity. But for those that lease from September to September, well, they're kind of in the thick of it. And what I've seen after speaking with a lot of the large student housing operators is that leasing velocity for that September month is a little bit slower. But by and large, it's still continuing through virtual tours. And those buildings are getting leased up as students have kind of an expectation that they will want to be at school for that next year. And obviously, you know, we're keeping a watchful eye on what universities are saying, and you know, in particular, what the government's saying as that Canadian relief, I forget the acronym, but that is now also applying to students. But more on the brokerage side, I think you're going to continue to see very strong interest in purpose-built student accommodation. You know, if you just look across the globe, Canada has a very underdeveloped student accommodation market. And we're just starting to have these big players. So, you know, if you think about in the UK, they have, for every 100 university students, they have 33 university beds, student accommodation beds, right? In Canada, for every 100 students, we have 3. So really underserved. And prior to this pandemic, we were hearing from the largest pension funds, we were hearing from foreign capital that they want to be in that space in Canada, and in particular, VETCOM markets, the major municipalities in Canada. So I think that's going to continue. And I think as long as your student housing building is positioned near a university, that's a good university, you'll be able to effectively weather the storm.
Few days on the student side of things. Let's switch over to purpose-built rental, regarded as a balance sheet play compared to your traditional condo development. What preparations are being made with view of rents, expenses, completion dates, IRRs, etc.? Adrian, maybe you can share that, given you're in the midst of a couple developments right now.
Yeah, thanks, Matt. I would say I'm overall probably more pessimistic than my residential development colleagues in the market. I would say, risk-adjusted returns are always a primary focus of ours. I think it's unquestionable that the cost of equity has repriced at a higher rate. To what degree, I think we're still trying to wrap our head around it and having lots of conversations with institutional investors and ultra high net worth investors. But I think there's definitely a repricing of equity. I think the inputs that drive those returns also need to be adjusted. And again, to what degree we're still trying to figure out. It's such a fluid market and things are changing, almost by the week. We don't really have a solid in-house view, but we definitely have a view, which I'll talk about. What I can see is that the job market and the overall economy, I don't think anything's going to change until there's a vaccine. There will be the economy opening back up, and there's going to be a lot of political pressure and civil pressure to get people, getting them back into the workforce. I think that's really important, but nothing actually practically changes until we actually have a vaccine in place. And so it will take time to recover even in that situation. So I think there is a period of time where there is going to be a lot of volatility and there's going to be a lot of repricing. And you're seeing that in the equity markets. I think there's going to continue to be a lot of volatility in the equity markets, and that's going to carry over to real assets quite quickly. I think there's always trying to draw parallels and data points in the market. And the one parallel I can point to is what happened in the US multifamily market through the downturn. Now, this is, a lot of people have talked about this, very different, 2008 to what we're happening today. But I think the parallels are, in some cases similar. We saw double-digit declines in rental rates back in 2008, 2009 through, 10, 11. There was a quick recovery thereafter as one of the first asset classes to rebound. I think that's probably what you're going to see here. Is going to be as deep as 20%. I don't have a crystal ball, but I think we will see double-digit drops in rental rates. And so we have started kind of repricing and kind of relooking at our pro formas with a softer rental tone, with slower absorption, with 0% inflation for a couple of years, and then a recovery thereafter. And so that's how we're kind of repricing our deals. There are some debits and credits as it relates to your pro forma that are going to be a benefit, right? Financing markets are, LTCs are holding firm. And Jeremy, I'd love to hear from you as well as to, some of the maybe government intervention that's happening behind the scenes. But we're not seeing a drop in LTCs, which you did see in other markets back in 2008. And we're seeing a real drop in the underlying base rate, although margin expansion, but you're still seeing an all-in drop in financing rate. That's a benefit. And I would also say that we should see construction costs coming down as well over the next couple of years. I know Duncan's going to talk about that point. It's probably not going to happen immediately, but it's simple supply demand that drives that market. And if less people are in the market taking full development risk, which I believe is going to be the case, we should see construction costs coming down. Again, to what degree? It's unclear. It's too early, but we are starting to model that as well in our pro formas.
Great, thank you. As Adrian alluded to, Duncan, maybe you can give us a rundown of the construction world. What I'm hearing from a few clients is that perhaps these companies are sharpening their pencils a little bit to take the certainty of the contract in light of some uncertainties that might, exist a few years down the line. What's your experience?
Yeah, thanks, Matt. I think, maybe it's best to take a 6 to 12 month perspective on this for now. Just speaking to companies that may have shovel-ready projects that are wondering how to pivot and how to react for when the economy does open up and they're allowed to start. And actually, if you don't mind, maybe pause the live recording so I don't have to look at this in 6 months and see how wrong I was on my projections, but I'll go anyway. So I think we're all looking at a flight to quality in our investment and business decisions, and the trades are no different. But I don't think that necessarily is going to lead to any immediate short-term adjustment in construction costs. And that's really down to the current dynamics of the construction market. So as everyone on this panel and everyone probably listening has experienced, we've been in a period of rapidly escalating construction costs, and that's driven by a number of factors, but two primarily are a shortage of experienced labor and a massive demand surge from prolonged development boom. And in the short term, I just can't see the labor market adjusting quick enough to deliver skilled trades. I just don't think that's possible. And while the development boom may be over, the construction volume is going to remain high at least through the remainder of the year and early into next year. And I think that's the case for two reasons. One, the mega projects that are currently underway that have sucked up so much capacity, particularly in the Greater Toronto area, they're strong projects, they're pre-sold, they're pre-leased, and I think we're not going to see a Bay Adelaide stump anytime soon. So we're thinking about the Well, Mankey's, the LCBO, redevelopment, the Crosstown LRT, CIBC Square, you can go on. And then sort of what's coming in terms of starts in the fall. And the reality is that in the residential market, we generally build condos. And the condo market, construction is very much a lagging indicator. And so in Toronto alone right now, we have over 100 projects representing 30,000 units that are pre-sold and not yet under construction. And to Adrian's points about capital costs and cost of equity and people looking at their capital stack and risk, I think there will be some cancellations, but not nearly enough to make a material impact. And I do think most of the major trades will actually have their pipeline pretty much full for starts coming up later this year. But I do think there still is an opportunity to plan for success. If you are a rental developer, you're well capitalized, you are a Fitzrovia, you're a Daniels, or whoever, it just may mean not going out and seeking weakness in the market and retendering or tendering your project, hoping to find softness in pricing. But maybe you can go approach that sort of A trade, that really quality trade that maybe was giving you a hard time on the numbers and sharpening their pencils. It may be a chance to lock them up. And if you can see some savings in productivity, you can get a project done faster. You're going to see huge savings to your bottom line. So if we're looking to a way for, capture back some of that lost IRR that Adrian spoke about, locking in today with a great trade may actually be a good strategy. And then longer term, for sure, my crystal ball is a little bit murkier as to what's going to happen. But if you have a shovel-ready project, I don't think now is the time to play a game where you kind of wait to see what's going to happen in the construction market. Because the reality is you're delivering these projects 3 to 4 years from now, which will hopefully be into a sunnier climate for rental. So I guess that's my 2 cents.
It's great. Thanks for the insight, Duncan. Let's switch gears and talk to Jeremy. I'm sure you're a popular guy these days, Jeremy. I'm going to leave it open to you to talk about the questions you are being asked most frequently and kind of just to give an overview on the market. Hopefully your connection holds up for this one.
Great. Thanks, Matt. Yeah, I hope my connection's okay or my Wi-Fi is fine to get this going. Thanks for inviting me today, and it's a great opportunity, I think, to share some information right across the country. I've been asked today to talk about the debt environment overall, and the impact that it's had on spreads and interest rates, coupons, and things like that. And then at the end, just to prognosticate a little bit on where we see the market going in the near future. At First National, we lend from coast to coast. Many of the references that I use today, I will compare to 2008, 2009, because I think there are some great similarities. Maybe the causes of what's going on in the debt markets right now may be different, but the impacts are very similar in a lot of ways. And so if I just start by talking about the overall debt environment, I would say to a great extent, the debt market has frozen. I think it's kind of consistent with what Adrian had talked about in terms of the cost of capital overall. There's obviously various different lenders across the country at different costs of capital and different forms of liquidity. And many of them are sitting on the sidelines right now while they re-gauge what the overall market is. If you just think about bond yields in particular, which drives a lot of what we do every day in the term side of our business, down about 100 basis points in the last 7 or 8 months. And so the challenge for most lenders is that the Government of Canada bond does not form any real cost of capital to any of us. And so that drop in bond yields has been a major challenge to many lenders. And so if you're a life co or a pension fund, you might have been lending at 150 basis points over Canada 6 months ago. But today, you're looking for a coupon which gets you to the 3.5% to 4% range. And so for many lenders right now, they're just sitting on the sidelines. As we look at multifamily, which is really the point of the conversation today, the good news for everybody on the line today that's involved in the apartment space, this looked a lot like 2008, 2009. There is lots of capital available for insured financing. CMHC has very much stepped up and continues to support the market overall. And I can tell you they're overrun with volumes right now. The one thing I will say is that currently in April of 2020, there are fewer insured lenders in the marketplace right now. First National is what I would estimate to be one of 4 or 5 very active insured lenders, whereas normally there's upwards of 10. And so if I move on to the whole spread conversation, the demand has stayed as high or higher than normal, and the supply has diminished. And so if I just break it down from a spread and coupon standpoint, as I said earlier, the Government of Canada bond yield is really somewhat irrelevant in terms of our real cost of funds. So with a 60 basis point 5-year, or sorry, even lower than that now, 50 basis point 5-year bond, we were doing deals 6 months ago at 2.5% to 3% for 5 and 10 years insured. With the drop in bonds, even though our spreads have gone up because of the excessive demand that we're dealing with versus supply, our all-in yields are actually lower. So the coupons to the client are actually lower than they were before. So they're probably in the 2 to 2.25% range now to get financing. But again, one of the big challenges for multifamily lenders is that there's borrowers, is there's just not enough capital available. And so I would say borrowers that have created great relationships with lenders over the years will be able to satisfy their needs over the next few months. Those that have not established those types of relationships may well have a little bit more difficulty in terms of doing that. What I would say, again, the good news is it's really for most of our customers anyways that are seeking insured financing, it's business as usual for us. We're doing tremendous volumes of 5-year business, and we have a very large pipeline of 10-year business that we're really just trying to work through right now. So one of the biggest challenges is getting longer term insured financing right now has become very challenging. And if I can just give you a quick snapshot, most of us fund our insured mortgages through the Canada Mortgage Bond, and the access to 5 years in the Canada Mortgage Bond is much greater than it is for 10 years. And so meaning that the supply is just greater for 5 years over 10 years. So I think the reality is if you needed to get financing today, getting 1 year through 5 years is easier than getting 10 years. But the good news is like 2008, 2009, given the availability of this capital in the loan market, I think it will keep somewhat a lid on cap rates on multifamily assets, even though I do think there will be a repricing of multifamily assets in the investment market overall. But I think given the CMHC and the Government of Canada's support with many various programs, I think we'll see that access to cheap financing will keep the activity in the investment space going over the next 6 to 12 months. What do I see going forward on the debt side? I do think there will be more capital that comes into the space in the mid to late summer as some of those other competitors do start to come back into the business. Honestly, we would really very much welcome them back in because the current players in the market just can't handle the volumes that are out there right now. And so therefore you may continue to see upward pressure on spreads over the next 60 to 90 days.
Thanks for that, Jeremy. I'm going to switch over to Dayma. Dayma, you're a boots on the ground broker. You have some deals on the go. What are you seeing in that environment? Other than the obvious, we know a lot of things are on pause. Is anybody viewing this as an opportunity to acquire? Is that extra few percent to push the needle available? Give us your thoughts on what you're seeing with transactional world.
Yeah, sure. And that was super interesting, Jeremy, to hear about the debt side there. So in terms of transactions, I think it might be useful to kind of take a quick step back and just paint the picture of Canadian multifamily, just for context. So, in the last few years, multifamily has just become the hottest asset class around, and in particular, Canadian multifamily in the major markets, right? So, back in 2016, investment volume was just under $1 billion in Toronto, for instance. 2017, it was 1.4 billion. 2018, it was 2.4 billion, right? And now last year, I think we had just around 3.4. And in that same time period, the average price per unit's gone up from 153,000 a door to close to 280 a door for 2019, right? So what caused that major interest in multifamily? It's all the fundamentals. Population growth, lack of supply, barriers to home ownership, the low interest rate climate certainly doesn't hurt. And all of those factors are still there. So, in terms of active deals that we're working on, most groups are not being short-sighted and thinking that, the bottom is just going to fall out of the market. Yes, we've certainly seen, I've had a number of calls from, especially on the private side, groups and individuals calling to say, hey, where are the deals? We're ready to get aggressive, and where's the blood in the water? But, as most of us on the call know, especially those acquiring multifamily, like my average client is a 70-year-old, well-capitalized kind of family owner, right? These guys are not guys with the urgency who need to sell and who are willing to take a severe haircut. And so I don't think you'll see that happening unless they get into severe pain. And obviously we're going to be watching those May 1st and June 1st and July rent collections. We had ongoing deals prior to this that were negotiated before any of this major news came out. And that pricing is holding strong, in multiple transactions. So I hope I hope I'm not made wrong again by this as we watch the recording later. But I have a good feeling about that. I think largely, sure, some of the major groups had to drop deals, but by and large, most of these groups are really protective of their reputations, and so they want to move forward and complete those deals. So, I'm still quite bullish in multifamily in the longer term, and certainly groups are coming out trying to buy, but I don't think there's going to be any huge opportunities for a reduction in price anywhere.
And Mike, we had some good dialogue before we launched this session at 1. Maybe you can share a couple of your thoughts from the Timbercreek perspective.
Yeah, thanks. As much as I'd like to tell everyone that they shouldn't be buying multifamily and run from the asset class so we can hopefully buy some more, that everyone's gonna know that's a lie. At the end of the day, multifamily has, proven again to be a relatively defensive asset class and real estate investment, in kind of these times of uncertainty. So I think that will continue to attract a lot of capital to it. And it still does have, probably the best, borrowing and cost of debt market that's out there, as Jeremy was alluding to, with long-term CMHC money pretty cheap. We've been bombarding Jeremy with a bunch of deals over the last 6 weeks, and we've been able to lock in long-term rates at, I think our the lowest we did a long-term deal was in the 1.6 and change, and we've had some that have been obviously a bit higher than that, but the availability of long-term debt is, I think, still going to make it attractive. We're still looking at buying for sure, and still looking at opportunities. I think our focus is, as opposed to looking at the world and trying to figure out how it's going to change. And I think there's a lot of people right now, and you talk to a lot of people, and everyone's got their own opinion, which is great, but on how retail is going to be different, how hospitality is going to be different, how office is going to be different. And, you know, you can your head can kind of spin a bit after talking to everybody. You know, we're focusing on, you know, what do we think isn't going to change, and how is the world going to kind of still remain constant, or as close to constant as it was, and try to find, you know, opportunities there. And one of the things that always comes back is shelter. I mean, people need a place to live. You know, the way you consume goods, you know, may change, and whether that's you go to a retail store, you go to a mall, or it gets delivered to your door, you still have a door and you're still living somewhere. And same thing with office, whether you work from home, which I don't know about any of you guys, but I'm eagerly waiting to get back into the office with having 3 kids under 5 biting at my ankles all day. But you know, like whether it's people work from home, work in their office, they're still going to, again, that constant is still a home and still shelter. So we're still actively looking at deals. You know, what I think will be a bit different right now, and you know, why I think we, you know, hopefully see some opportunity here is for those groups who can remain active. You know, we did a presentation the other day to a few of our investors. It's, you know, the analogy was, you had one picture of, you know, a dog bowl with like 20 puppies all eating out of it, and them kind of all fighting each other to get their, you know, to get the food. And then, you know, that was what I would say the market was, you know, 6-8 weeks ago. And, you know, you fast forward today, and, you know, there's maybe 1 or 2 that are there. So, you know, I don't think there's going to be any real big fire sales or any big huge discounts. You know, what we're hoping is, and, you know, what I'd anticipate is probably, you know, you're going to see a lot less of those second and third round pushing the needle and everyone kind of moving up a little bit. You know, so if, for example, if we were to buy, you know, wanting to buy a property and we thought fair value was $100 for it, you know, 6 weeks ago, and we bid $100, that asset may have traded at you know, 110 or 112. And, you know, if I'm able today, for example, to buy that, you know, still, you know, for, you know, 98 or 97, or, you know, or relatively close to where we were before, you know, did I buy it for a big discount relative to what I thought it was worth? You know, maybe not. You know, is it a discount to what, you know, someone else is willing to pay for it? Yeah, and that's obviously what makes a market. But, you know, I mean, real estate should be valued on the long-term expected values of of cash flows, and obviously it's going to be, you know, a little bit of a bumpier road over the next little while. I agree. I think until vaccine is found and people have, you know, some feelings of safety and assurance that they can go back to living their lives, you know, as normally as they were before, it'll probably be, you know, a little bit of a bumpy road until then. You know, but it's kind of why we're remaining active in the space. You know, we're still looking for properties where we can add good quality real estate, that we believe in the long-term value of it. You know, as much as everyone would, you know, can say everyone's going to move to the suburbs, I mean, just it's, you know, it's physically, I don't really think it's physically, you know, achievable that you can have everyone move out and have their own plot of land and their own backyard and their own this and their own that, and achieve that in a really short period of time. So, you know, people are still going to need to live near, you know, urban centers, and there's still going to be, you know, public transit and community amenities and all that stuff. Will come back. At least I believe it'll come back, and I hope most people do believe it will, because if not, it's probably a bit of a scary place for the world to be. But yeah, so that's kind of where we're at.
That's good insight. It's always good to hear that there's some activity behind the scenes that not everybody's privy to, and activity's still going to go on. Greg, you've been quiet for a little bit. We're going to ask you about, you know, the realities of these low cap rate environments we've seen, the run up that Dayma discussed over the past few years, the penchant to, you know, get in and renovate suites, renovate common areas, retrofit, make sure your building is very efficient from an energy standpoint, management standpoint, and really extracting the meat on the bone, if you will. And we've seen these extremely low cap rates as a result. How are you viewing your portfolio, given turnover is going to be challenging during COVID, and you know, with a view of the rental market where lifts, you know, might head, that these kind of low cap rates are reliant upon?
Look, I'm pretty optimistic, but our of the medium and long term. But the short term, our focus really is maintaining occupancy, doing collections, and serving our residents. So I think, like most of the large landlords in the country, we kind of pledged not to increase rents during the pandemic, and that's something that we're sticking to. We don't have the view that there's necessarily going to be a vaccine ever for this thing. I mean, we look at HIV. Here we are 40 years in, there's no vaccine. So this idea that we're necessarily going to have a vaccine and that's going to make the difference between us all returning back to life. And I just don't see that that's something that we can realistically hope for. So, but I do think we're going to get back to work in the not too distant future. And, people will be out renting. So for today, our focus is on continuing to lease. So some interesting statistics. Our lease velocity dropped, call it 30%, 35%, which is pretty good. The amount of traffic is about the same. So I would say the average quality per lead has dropped off, and that's because more people have more time, so they're spending more time shopping. And also, it's very difficult in this kind of business to do your in-person closing, right? So where you can sell your value proposition and the strength of your frontline staff's ability to quote unquote sell the proposition is impaired. I mean, we do have online tools that allow us to do that, but it's never the same. But we do think, the priority today is to lease the units that you have, to keep the residents in place and look for, opportunities in the future. So things like renovations, we've slowed down on. In some places, you still can do renovations when the unit turns over because it's vacant. The challenge that we've actually had in those places, particularly out west, is because people are now home, the hammering that would have happened before because no one was at home or very few people were at home and didn't notice the noise, now they're noticing the noise. So we've actually had to slow down on renovation work, which means, we have a choice. We can either rent those suites today or hold them and wait to renovate them. And our view is, okay, we've taken a third tact, which is we're using a slower renovation technique, which is less noise intrusive, but at least things are moving ahead. So we don't think that our NOIs or our rental income in the short term is really going to be impacted. In fact, our medium term forecast is that rents are going to go up because this is very different than the United States, where they actually had, a development industry which had vacancies available. Canada-wide, we pretty much have no vacancies, and we still have a lot of tailwinds behind the creation of rental demand and a shortage. And with the number of people that are either worried about losing their homes, like ownership, I think there's going to be a further trend behind this industry, which we haven't seen in Canada for a long time. And that's going to be people deleveraging and moving into purpose-built rental from home. So I think there's a lot of tailwinds, but we just have to be patient before we get them.
Mike, do you have any insight on that topic of kind of the low cap rate environment and extracting that, value through renovation, mark to market, via turnover? Do you have any concerns? I mean, you expressed interest to buy, so I suspect you don't have concerns, but if you have a quick thought on that, I think it would be helpful.
No, I think like Greg said, right? I mean, it's everyone's got to be patient right now. I mean, there's your tool belt is somewhat figuratively and literally limited right now. We're not giving increases as well, like most landlords across the country. So I think you got to be patient. I do agree as well with Greg and share the same sentiment that we do have a very low vacancy rate in Canada. So, I mean, it's not as if we have an overabundance of supply where I see a big downward pressure on rental rates. Supply takes a long time to get into the system, as all of us know and experience. I mean, I know Adrian would probably like to get a building up in 12 or 14 months, but that's sometimes how long it might take him to get a first meeting to even talk about it. So, I still think there's going to be a supply issue. I think you'll continue to have, I think you'll have more demand as people don't enter into home ownership. I think that'll continue. And I think it really, in markets that are rent controlled, as much as the gap to what was in place to where your rent roll is sitting was widening out. And so you had a lot of organic growth as you turned rents over. Turnover was slowing down at a pretty material pace as well. So, we took stats and looked back at what happened in 08, and, you got to be careful of drawing too many parallels, but, we saw, back in 08, 09, and 2010, you had more turnover in the, the one bedrooms and the bachelors as people were coupling up and people were moving back in with family, et cetera, because they couldn't afford to have their own place. So you had some more turnover in those suites. And then, as the economy recovered, those two bedrooms again began to decouple, and people, moved out of having with roommates and moved out of their parents' basements, et cetera. And you saw those two bedrooms turn over again. So, again, I think if you take a long-term view, I think over the long term, that gap to market may shrink a bit, but with increased turnover over that same period of time, you may find yourself getting to kind of the same end point. How you get there, there's always speed bumps and there's always different ways to get from point A to point B. But I believe, long-term directionally that you'll still be able to grow your NOIs over the long period of time, just given where rents are typically sitting. And I think that's a much more broad statement for markets that are rent controlled versus not.
Thanks, Mike. We're down to our last 10 minutes here. We have one question left for Adrian and Duncan. You guys can kind of share 5 minutes or so each on, wrapping up. And the subject of this presentation was kind of, is multifamily stable in unstable times? Maybe you guys can relate that to purpose-built rental softening as a result of COVID, and if you believe multifamily will attract additional investment and be viewed as a safe haven in times of volatility. Dunk, maybe you can start.
Sure. Yeah. So I think the reality is that if you need to go acquire land, rental development pro formas are skinny. And they often work because you're assuming an increase in rent over time. And I think Adrian alluded to, there may be some short-term softening in rents, absorption, that may cause some groups to pause and take a look at their portfolios. But particularly if they've been impaired elsewhere, if they have some struggling retail assets, office assets, whatever the case may be. But I really do think this is creating an opportunity for those groups with some resolve and dry powder to get into the rental business in a meaningful way if they can take a bit of a longer term perspective. And I think the way we look, and I look at COVID-19, is it's more of an accelerant of trends that were already happening rather than structurally changing the economy. So if you look at something, we talk about the shift to online shopping versus retail. That's nothing new. It's been accelerated by COVID. But if you go talk to any institutional owner of a mall in Canada, of a retail plaza in Canada, for years they've been talking about multifamily intensification. And in a post-COVID world, I can't see them sitting idly by while Amazon and Netflix take more of their shoppers' shopping dollars, entertainment dollars. They need to be defensive. And I think a great way to be defensive is to put up some residents where you shop and to intensify your plaza, create vibrant sort of mixed-use communities, as we see happening across the GTA and in other major markets across Canada. So I think that will continue. And another thing that I think might be interesting is we're talking about access to equity. And we've seen such a run-up in land prices, generally driven by condominium economics in the large cities in Canada. And primarily that's because we've been able to do some pretty creative things with our capital stacks, and groups have taken on different sorts of levels of mezzanine equity and mezzanine debt. And I think the cost of all that is going to go up. So I don't think the condominium guys can be quite as aggressive on purchasing or driving up land price. And that may actually allow an access point for some well-capitalized long-term rental groups to actually access A sites where, I've always been amazed at Fitzrovia and a couple of groups being able to access those sites in, the pre-COVID world, but very few have been able to compete with condo guys. And I actually see that opening up. And I think it's interesting because I think taking a long-term view in 3 years, 5 years, 10 years, we're going to need more housing in Canada, particularly in our major cities. I think that's just, in my opinion, a given. And I'm curious about the composition that purpose-built rental is going to play in that, because if you compare and contrast Chicago versus Toronto, similar sized cities, in the last decade, Chicago built 50,000 purpose-built rental units. Toronto built 10 to 15,000. But we have all these cranes in the sky. Why? Condos. We've built over 175,000 condo units. And so the market seems to be saying the best way to deliver our rental supply is through the shadow economy and mom and pop landlords. And that's really what's happened. But I think everyone on this call and everyone on this panel would probably believe they're a better landlord. I have to believe that Mike and Greg are probably a landlord of choice rather than, Joe Schmo condo owner. But the reality is the institutions need to step up and make that bet and make that call. And so if there is a bit of softening in the condo market, I think the demand is going to be there for rental guys to swoop in and be a bit, I don't want to use opportunistic, but take advantage of that opportunity. But we will see.
Adrian, send us off to the finish line.
Yeah, so I agree with Duncan. I think that's well said. As it relates to the demand side, the occupational market, one of the things I've heard since I moved back to Canada 7 years ago was immigration, and it was a job growth story. I think until the borders open back up, sucking 400,000 people out of the Canadian economy is going to have a short-term impact. Long-term, on a relative basis, I think multifamily is a great play and defensive play on the economy. So still very bullish. I think you're going to see more and more institutional capital coming into the space. I think we talk about structural issues that's happening in the market right now. The amount of fiscal stimulus that's being pumped into the economy by the government, that could lead to inflation down the road. And there's no better place to be, as everyone knows, than being real assets. I would also take that further within multifamily, given you have rolling 12-month leases to be a perfect hedge on inflation. So very bullish in the medium to long term. In the short term, I think patience and diligence is key. One of my lessons learned, when worked in Europe through the downturn and spent a lot of time in the US, was investing too quickly through the downturn. The recovery always taking much longer than you expect. And I think it's important to, really watch how you capitalize your deals, watch your downside, making sure that you're paid to wait on a recovery. And so we're really focusing on that as we look at new product and new opportunities. We're definitely going to be acquisitive. We want to be a net acquirer in this market, but we're being very careful in terms of the types of deals we're looking at, very locationally focused, and also how we capitalize those deals and how we underwrite those deals.
Thanks for that insight, Adrian, and thanks for kind of ending us off there. Thanks to everyone for joining us today. We're running out of time here, so we won't be able to go through any of the Q&A that came through. Feel free to email me offline, but I want to thank our panelists for taking time out of their busy schedules. I know those who have kids and all the things going on, it's challenging to find time, so really appreciate it. The content was top-notch as expected. And again, if anybody has any questions, email into the link we sent across. We'll do our best to answer them. Thanks to everyone and have an excellent weekend.